All right, diving in today, ready to decode some serious business lingo. We're talking accounting.
Yeah, think of it like this. We're giving you the keys to the kingdom, the financial kingdom, that is. We're going deep on the numbers that make businesses tick and maybe even help you make sense of your own money matters along the way.
Exactly. And our roadmap for this expedition, Wayne Label's book, Accounting for Non-Accountants, which does exactly what it says on the tin, lays it all out, nice and simple, no intimidating jargon.
The mission here is to extract those core concepts from the book. We want to show you why knowing this stuff is so powerful, not just for the number crunchers out there.
It's like getting X-ray vision for any business, right? Like whether you're thinking about investing, taking out a loan, or even just scoping out a potential employer, you can really see what's going on under the hood.
And if you're running a business, forget about it. This is fundamental, right? Planning, budgeting, making those big borrowing decisions, investment choices. It's all about having the information you need to make smart moves.
So this book is pretty wide-ranging. It covers everything from financial statements to different business structures to even how to protect yourself from fraud.
We're going to hit the high points, the core ideas that are going to make you fluent in the language of business.
Perfect. So let's start at the very beginning. What exactly is accounting? I mean, we all have a vague idea, but
Right. Well, the simplest way to put it is that accounting is about recording, classifying, and summarizing everything that's happening financially in a business.
so more than just keeping track of income and expenses.
Oh, way more. It's about taking all those transactions, organizing them, and creating these financial statements that tell a story. You've probably heard of them: the balance sheet, the income statement, the statement of cash flows. Those are the big three.
And the goal of all this is
To give people the information they need to make good decisions about money. For a business, that's about operating efficiently, maximizing profits, keeping costs under control, all that good stuff. Accountants are the ones who interpret all that data and provide the insights.
Okay, so who's looking at this information? I mean, obviously the business owners, but
But it's a much wider audience than you might think. Individuals use accounting all the time. Like if you're thinking about investing in a company's stock or maybe applying for a mortgage, even just sizing up a potential employer, right? You want to know if they're financially stable, a profitable company is generally a safer bet.
that's a great point.
Yeah.
What about inside the company itself? Who's using these reports?
Pretty much every department relies on accounting data. The marketing team, they want to see the sales figures, figure out which campaigns are working. Production managers, they're looking at cost reports to optimize manufacturing. R&D, they need to justify their budget with projected returns. The book has a great section, figure 1.2, I think, that shows all the ways different departments use accounting information. Without it, they'd be making decisions in the dark.
And I'm guessing bankers want a good look at the books before lending any money.
Oh, yeah. Absolutely essential for bankers. They need to assess the risk, right? Figure out if a business or an individual is a good credit risk. They use accounting info to manage their clients' investments, even to set interest rates. Figure 1.3 in the book breaks down how bankers use these reports. And then you have government agencies, the IRS, the SEC, the FTC. They all need accounting information to make sure everything's on the up and up.
So it's not just internal to the business. It has a much broader impact. Now, the book makes a point of saying that accounting isn't the same as bookkeeping. What's the difference?
Yeah, good question. Bookkeeping is the day-to-day recording of all those financial transactions, sales, purchases, payments, all that. Accounting takes that raw data and steps it up a notch, organizes it, summarizes it, and then interprets it, provides the insights for decision making. It's about seeing the big picture, the trends, the relationships between all those financial activities.
Gotcha. So bookkeeping is the foundation, but accounting was about building on that foundation to actually make sense of it all.
Exactly. As a business grows and things get more complex, you need more sophisticated information to make good decisions. You can't just rely on a list of transactions. You need to understand what those transactions are telling you about the health of the business.
Okay, now let's talk about the different types of business structures, because the book points out that this matters for accounting too. What's the big deal if a business is a sole proprietorship versus a huge corporation?
Well, how the business is structured legally and organizationally, whether it's a sole proprietorship, a partnership, or a corporation, has a big impact on how its financial information is handled. These are the three main forms you'll see in the US, right? Sole proprietorship, one person runs the show, often a smaller business. Partnership, two or more people team up, share the profits and the losses. And then you've got corporations, which are these separate legal entities owned by stockholders.
And so the accounting is different for each of these.
Yeah, it can be. For sole proprietorships and partnerships, the business finances are separate from the owner's personal finances, but the accounting is usually more straightforward. Corporations, on the other hand, they're more complex beasts. Because they're separate legal entities with ownership divided up into shares of stock, they have more complicated accounting and reporting requirements.
And what about the financial statements themselves? Do those vary?
The core statements are the same for all these types. The balance sheet, the income statement, the statement of cash flows, but the specifics will differ, especially in the equity section. For example, corporations will have a stockholders' equity section, while sole proprietorships and partnerships have owner's equity or partner's equity. It's important to remember that these statements, they're not just standalone documents. You need to look at all three together as a package deal to get the full financial picture.
Makes sense. You can't just focus on one piece of the puzzle. Now, you mentioned earlier that there are rules for how these financial statements are put together. Let's talk about generally accepted accounting principles, or GAAP. Sounds very official.
It is. GAAP is basically the Bible for accounting in the US. It's a whole set of rules, standards, and guidelines that make sure financial information is presented fairly, consistently, and in a way that can be compared across different companies. This is crucial, especially for those external stakeholders we talked about earlier, the investors and lenders. They need to be confident that the numbers they're looking at are reliable and comparable.
And the book goes through some of the key principles. What are some of the must-knows?
One of the most fundamental is the historical cost principle, which means assets and liabilities are recorded at their original cost. So if a company buys a machine for $5,000, that's what goes on the balance sheet, minus any depreciation. And here's a big one. In the US, you generally can't just write up the value of your assets, even if they become worth more in the market. This is different from how some other countries do things.
That's interesting. Why the focus on the original cost?
Because the original cost is objective, you can verify it. If you started recording assets at their market value, which can fluctuate, it would introduce a lot of subjectivity and potential for, well, let's say creative accounting. Sticking with the original cost keeps things reliable and verifiable.
So it's about sticking to the facts, no fudging the numbers. What else is important?
Consistency is another biggie. If a company chooses a certain accounting method, they need to stick with it over time, apply it consistently to similar transactions. That way you can compare their financial performance from one period to the next. Then there's the entity concept, which is all about keeping the business's finances separate from the owner's personal finances.
Right, so no dipping into the company coffers for a new car.
Yeah.
What about that going concern principle you mentioned?
Right. The going concern principle assumes that a business is going to continue operating in the foreseeable future. This affects a lot of accounting practices, like how you depreciate assets over time. You wouldn't depreciate a machine over 10 years if you thought the business was going to shut down next year.
Makes sense. And then there's the monetary unit principle, which sounds pretty straightforward. Everything's reported in a stable currency, like US dollars.
Right. You got to have a consistent unit of measurement. Can't be switching currencies all the time. It'd be chaos.
Now, the book mentions a few principles that sound a bit more cautious, like the conservatism principle. What's that all about?
Conservatism, it's all about being careful, not overstating assets or understating liabilities. Basically, not painting too rosy a picture. When there are multiple ways to account for something, you choose the one that's least likely to inflate the numbers. It's a bit like better safe than sorry when it comes to accounting.
I like that approach, keeping it real. What about some of these other principles, like reliable and relevant information? Those sound important.
They are. Reliable information, it has to be accurate, based on solid evidence, not just someone's gut feeling. Verifiable means independent people should be able to come to the same conclusions using the same data. And relevant information, well, it has to be useful for decision making, help people understand the past and predict the future. Then there's materiality. You don't have to report every little detail, just the information that's actually significant enough to influence decisions.
So it's about quality over quantity. What about the realizable value and recognition principles?
The realizable value principle, that means you shouldn't record assets at a value higher than what you could realistically sell them for. And the recognition principle dictates when you actually record revenues and expenses. Revenues are generally recognized when they're earned, typically when goods or services are delivered. Expenses are recognized when they're incurred, when you've used up resources to generate that revenue.
Got it. So it's not just about when the cash changes hands, it's about when those economic events actually occur. What about obtainable and quantifiable information?
Obtainable information just means the information should be accessible, available to those who need it, without costing an arm and a leg. And quantifiable, that means the information should be in numbers, as much as possible. Numbers tell a clear story, but sometimes you need explanations too, and those go in the footnotes. And finally, we've got the stable monetary unit concept, which basically reinforces the historical cost principle and says you don't typically adjust financial statements for inflation.
Wow, that's a lot of principles, and it sounds like GAAP is designed to make sure everyone's playing by the same rules
Yeah.
and that the information is trustworthy.
Exactly. Now, the book does touch on the fact that there are some differences between U.S. GAAP and the International Financial Reporting Standards, or IFRS. That's a whole other can of worms. But the main takeaway for your listeners is that even though the goals are the same to provide useful financial information, the specific rules can differ.
So even in the world of accounting, there's no one-size-fits-all approach. Globalization, huh?
Yep, the world's getting smaller, so understanding these different standards is becoming more and more important, especially for businesses that operate internationally.
Okay, so now that we've got a handle on GAAP, let's dive into those financial statements themselves. The first one up is the balance sheet. What does this statement tell us about a business?
The balance sheet is like a snapshot. It gives you a picture of the company's financial position at a specific point in time. It shows you what the company owns, those are its assets, what it owes to others, those are its liabilities, and the difference between the two, which represents the owner's stake in the company, that's the owner's equity. And the key equation that drives the whole thing is assets equals liabilities plus owner's equity.
Or, as the book puts it, assets minus liabilities equals owner's equity. Same thing, different way of looking at it.
Exactly. The point is, it always has to balance. Everything a company has, its assets, are ultimately financed by either borrowing money, which creates liabilities, or by the money the owners have invested, plus any profits the company has retained, that's owner's equity.
Got it. Let's break this down further. What exactly qualifies as an asset on the balance sheet?
Well, the book outlines three key criteria. First, the company has to control the asset, which usually means they own it. Second, the asset has to have some potential to benefit the company in the future, like generating revenue or reducing expenses. And third, the value of the asset has to be reliably measurable.
So there has to be some objective way to put a dollar figure on it. That makes sense. The book also gives some interesting examples of things you might think are valuable to a company, but don't necessarily show up as assets under U.S. GAAP.
Right, like employees. They're incredibly valuable, but a company doesn't own their employees in the same way they own a building, so they don't appear as assets on the balance sheet.
What about things like a company's brand reputation or a killer location? Those could be huge advantages.
Absolutely, but they're hard to put a precise dollar value on, so under GAAP, they usually don't show up as assets. The book even points out that if someone gifts an asset to a company, it often doesn't get recorded as an asset because there was no historical cost associated with it.
Okay, so it's not just about what's valuable, it's about what fits the specific criteria of an asset under GAAP. What about those intangible assets? Things like trademarks and patents.
Those can be listed as assets as long as they meet those three criteria, which usually means the company acquired them through a purchase or development. They might not have a physical form, but they definitely have economic value and the potential to generate future benefits.
Okay, let's switch gears to the other side of the equation. Liabilities. What are those?
Liabilities represent what the company owes to others. They can be short-term, meaning they're due within a year, like accounts payable, which is money owed to suppliers. Or they can be long-term, like a mortgage on a building. And the book points out that even with long-term debt, the portion that's due within the next year is usually classified as a current liability.
So you've got to break down those long-term obligations and see what portion is coming due soon.
Right. And finally, we have owner's equity, which is essentially the owner's stake in the company. It's what's left over after you subtract the liabilities from the assets.
So it's like their net worth in the business.
Exactly. For sole proprietorships and partnerships, this often includes the owner's initial investment in the business, plus any retained earnings, which are the profits the company has kept instead of distributing them to the owners.
And for corporations, it's a bit more complicated.
Yeah, for corporations, the equity section is called stockholders' equity, and it includes things like the value of the shares issued common stock, preferred stock, and, again, retained earnings. Remember, the balance sheet always has to balance. The assets have to equal the liabilities plus the owner's equity.
Right, and the book uses this fictional company, Solana Beach Bicycle Company, to illustrate how different transactions affect the balance sheet. Can we walk through a few examples to see how this actually works?
Absolutely. Let's start with the initial investment. Say the owner, Sam, put $60,000 of her own cash into the business. On the balance sheet, the cash account, which is an asset, increases by $60,000. And on the other side of the equation, owner's investment, which is part of equity, also increases by $60,000. So it balances.
Pretty straightforward. What happens when they start buying assets for the business?
Okay, let's say on January 1st, Solana Beach Bicycle buys land, a building, and a truck for a total of $43,000. They pay $23,000 in cash and take out a $20,000 mortgage. So on the balance sheet, the cash account decreases by $23,000, and you have new asset accounts appearing, land, building, and truck, totaling $43,000. At the same time, a liability account, mortgage payable, appears for $20,000.
So the total assets have gone up and the liabilities have gone up to balance it out.
Exactly. You started with $60,000 in cash, spent $23,000, and added $43,000 in new assets. So now you have $80,000 in assets. And on the other side, you have $20,000 in liabilities and $60,000 in owner's equity, also totaling $80,000.
Okay, let's do one more example just to really cement this.
Sure, let's say Solana Beach Bicycle buys a 3-year insurance policy for $1,500, paying with cash. So the cash account goes down by $1,500, and a new asset account, prepaid insurance, appears for $1,500.
Prepaid insurance is an asset.
It is. Think of it this way.
Talk.
The company has paid for something that's going to benefit them in the future. That's the definition of an asset. A portion of this prepaid insurance would be classified as a short-term asset, representing the next year's worth of coverage, and the rest would be long-term. But the key point is they've just exchanged one asset, cash, for another asset, prepaid insurance. The total assets haven't changed.
Got it. So with every transaction, the balance sheet has to stay in balance.
Always. It's a fundamental principle of accounting.
Okay, now let's move on to the income statement. This statement tells us how a company performed financially over a specific period, right? Like a month, a quarter, or a year.
Right. It's all about performance. Did they make money or lose money? It summarizes all the revenues the company earned from selling its products or services and all the expenses it incurred in the process. You might hear it called the profit and loss statement, or P&L, or the statement of operations.
And this is where we see the famous bottom line.
Exactly. The bottom line tells you the net income, which is the profit if revenues are higher than expenses, or the net loss if expenses are higher than revenues.
So how is the income statement typically organized?
It usually starts with revenues, the money the company brought in. Then you subtract the cost of goods sold, which is the direct cost of producing those goods or services. The difference between revenues and the cost of goods sold is the gross profit.
So that's the profit before you factor in all the other costs of running the business.
Exactly. Then you subtract all those operating expenses, things like salaries, rent, utilities, marketing. That gives you the operating income. Well, there might be other revenues or expenses that aren't directly related to the core business operations, as well as interest expense and income taxes. You subtract those to arrive at the final net income.
Okay, that makes sense. Now, the book makes a big deal about accrual accounting versus cash basis accounting. Why is that distinction so important?
It's crucial because GAAP usually requires businesses to use accrual accounting. Accrual accounting recognizes revenues when they're earned, even if the cash hasn't been received yet, and it recognizes expenses when they're incurred, even if the cash hasn't been paid yet.
So it's not just about when the money changes hands, it's about when the economic activity actually occurs.
Exactly. Cash basis accounting, which some smaller businesses might use, just records transactions when the cash comes in or goes out. But accrual accounting gives you a more accurate picture of a company's financial performance because it matches the revenues with the expenses that were incurred to generate those revenues in the same period.
So accrual accounting gives you a clearer view of the true profitability of the business in a given period.
Right. And this leads to another important distinction: the difference between an expenditure and an expense.
Yeah, I've always found that a bit confusing. Can you clear that up for us?
Sure, an expenditure is just when you spend money on something. But not every expenditure is an expense right away. An expense is an expenditure that's been used up or consumed in the process of generating revenue.
Can you give us an example?
Yeah, imagine a company buys a delivery truck. That's a cash expenditure. But you don't record the entire cost of the truck as an expense on the income statement right away. Instead, you spread that cost out over the truck's useful life through depreciation. Depreciation is an expense that reflects the fact that you're using up the truck a little bit each year to generate revenue.
Okay, so depreciation is an example of an expenditure that becomes an expense over time.
Exactly. You match the expense with the revenue it helps generate. The book shows how specific transactions affect both the balance sheet and the income statement using Solana Beach Bicycle Company. Want to go through one of those examples?
Yeah, let's see how this all plays out in a real-world scenario.
All right, let's say Solana Beach Bicycle sells 2 bikes for a total of $500. Those bikes originally cost them $200. So on the income statement, you'd record $500 as sales revenue and $200 as cost of goods sold. The difference, $300, is their gross profit. And on the balance sheet, assuming it was a cash sale, the cash account would go up by $500 and the inventory account would go down by $200.
So the income statement is showing the profit from those sales, and the balance sheet is reflecting the changes in the company's assets.
Right. Now, what if they sell a bike, but the customer doesn't pay in full right away?
Okay, so they make the sale, but they don't have all the cash yet. How does that work?
Let's say they sell 10 bikes for $5,000 total, and those bikes cost them $2,000. They get $3,500 in cash up front, and the other $1,500 is on credit, so the customer owes them that amount. On the income statement, they would still record the full $5,000 as sales revenue and the $2,000 as cost of goods sold, because under accrual accounting, you recognize the revenue when it's earned, not just when the cash is received. And on the balance sheet, the cash account would go up by $3,500. A new asset account called accounts receivable would be created for the $1,500 the customer owes, and the inventory account would go down by $2,000.
Got it. So the income statement is showing the full revenue earned, even if all the cash hasn't been collected yet. And this brings us to a key point the book really stresses. Net income isn't the same as cash flow. Why is that such a big deal?
Because a company can be profitable on paper according to the income statement, but still be short on cash. This can happen if a lot of their sales are on credit and their customers are slow to pay. They've earned the revenue, so it shows up on the income statement, but they don't actually have the cash in hand to cover their expenses.
Which is why we need that third financial statement, the statement of cash flows. What exactly does that tell us?
The statement of cash flows tracks all the cash coming in and going out of the business. It shows you where the cash is coming from and where it's going, which is essential for understanding a company's liquidity.
Liquidity meaning?
Meaning their ability to pay their bills as they come due. The statement of cash flows breaks down the cash flow into 3 main categories: operating activities, investing activities, and financing activities.
Okay, let's unpack those. What are operating activities?
Operating activities are the cash flows from the core business operations, the day-to-day stuff. For Solana Beach Bicycle, this would include cash from selling bikes, cash from repair services, cash paid to suppliers, cash paid for rent, all that. This section also adjusts net income to show the actual cash flow from operations, taking into account things like changes in accounts receivable and accounts payable.
So it reconciles the income statement with the actual cash coming in and going out related to operations.
Right. Then you have investing activities, which deal with the cash flows from buying and selling long-term assets. Like when Solana Beach Bicycle bought that land, building, and truck, that would show up here.
And financing activities.
Financing activities are all about how the business is funded. This includes things like taking out loans, issuing stock, and the owner's initial investment in the company. By looking at these 3 categories, you get a comprehensive picture of the company's cash flow.
Got it. And the book analyzes Solana Beach Bicycle's cash flow for 2013. What can we learn from that?
Well, what's interesting is that in 2013, Solana Beach Bicycle actually had negative net cash flow from operating activities, meaning they spent more cash on their day-to-day operations than they brought in. This isn't necessarily a bad thing, especially for a new business that's investing heavily in growth.
Right. They had those big cash outflows for investing activities when they bought those long-term assets.
Exactly. But they also had a big cash inflow from financing activities, mostly from the owner's investment and that mortgage. So overall, they ended the year with a net increase in their cash balance.
So even though their operating activities were using up cash, their financing activities more than made up for it.
Exactly. And the ending cash balance on the statement of cash flows should match the cash balance shown on the balance sheet at the end of the same period. It's another way to make sure everything ties together.
Okay, so we've got a handle on the 3 main financial statements. But just having the statements isn't enough. You have to be able to analyze them. The book talks about short-term financial statement analysis using ratios. What's the point of calculating these ratios?
Ratios are like financial shortcuts. They take numbers from the financial statements and put them in relation to each other so you can quickly assess key aspects of a company's financial health, especially in the short term, like the next 12 months.
So what are some of the key ratios for short-term analysis?
One of the most common is the current ratio, which measures a company's ability to pay its short-term obligations. You calculate it by dividing current assets by current liabilities. A current ratio of 2 or higher is usually considered good, but again, it depends on the industry.
So a company with a current ratio of 2 has twice as many current assets as current liabilities, meaning they're in a good position to pay their bills as they come due. What other ratios are important?
The quick ratio, also called the acid test ratio, is another important measure of liquidity. It's similar to the current ratio, but it excludes inventory from current assets because inventory might not be easy to convert to cash quickly. You calculate it by dividing quick assets, current assets minus inventory, by current liabilities. A quick ratio above 1.5 is often considered healthy.
So it's a more conservative measure of liquidity. What about working capital? Is that a ratio?
Working capital isn't a ratio, but it's a key figure in short-term analysis. It's just current assets minus current liabilities. It tells you how much liquid assets a company has to fund its day-to-day operations.
So a healthy working capital balance is essential for keeping the business running smoothly. What other ratios does the book cover?
There's the inventory turnover ratio, which measures how efficiently a company is managing its inventory. It's calculated by dividing the cost of goods sold by the average inventory. A high turnover ratio generally suggests strong sales or efficient inventory management, but it could also mean they're running low on stock. A low turnover could mean weak sales, excess inventory, or inefficient purchasing practices.
You have to look at the context. A grocery store is going to have a much higher inventory turnover ratio than, say, a jewelry store.
Exactly. And then there's the average collection period, which measures how long it takes a company to collect its accounts receivable. It's calculated by dividing average accounts receivable by average daily sales.
So a longer collection period could be a red flag, right?
It could mean they're having trouble collecting payments, which can strain cash flow. The book's analysis showed that Solana Beach Bicycle had a collection period that was longer than their credit terms, which might be something they need to address.
Okay, so these ratios give us a snapshot of a company's short-term financial health, especially its ability to pay its bills and manage its working capital. Now, let's talk about the elephant in the room, fraud and ethics. The book dedicates a whole chapter to this. Why is this so important, especially for businesses?
Because the integrity of financial information is paramount. If the numbers are unreliable, if there's fraud going on, it can have devastating consequences. And unfortunately, small businesses are often particularly vulnerable to fraud.
Really? Why is that? You'd think larger companies would be bigger targets.
Well, small businesses often have fewer employees, which can make it harder to separate duties, to have checks and balances in place. The book cites some alarming statistics from the ACFE that show a high percentage of fraud happens in smaller organizations. And sometimes there's just a culture of trust which can be exploited.
The book introduces something called the fraud triangle. What's that all about?
The fraud triangle is a model that helps explain why fraud occurs. It says you need three things: opportunity, rationalization, and pressure or incentive. Opportunity is when there are weaknesses in internal controls that allow fraud to happen. Rationalization is how the person committing the fraud justifies their actions. Maybe they think they'll pay it back or they deserve it somehow. And pressure or incentive is the motivation, like financial difficulties or pressure to meet targets.
So all three elements of the triangle usually need to be present for fraud to occur. What are some of the most common types of fraud small businesses need to watch out for?
Embezzling cash is probably the most common, but there's also stealing assets like inventory or supplies. Kickback schemes where employees get secret payments from vendors are also common. You also have to worry about things like forged checks, fake invoices, misuse of company credit cards, even just plain old petty cash theft. And then there's financial statement manipulation, trying to make the business look better than it really is.
Sounds like there are plenty of ways for fraudsters to try to game the system. What can businesses do to protect themselves? The book talks a lot about internal controls.
Internal controls are essential. Even basic ones can make a big difference. Separating duties so different people are responsible for different parts of a transaction is crucial. Requiring approvals for expenditures over a certain amount, using pre-numbered invoices and checks, and regularly reviewing bank statements are all important steps. The book also mentions a free online tool available at www.businessfraudprevention.org that can help businesses assess their fraud risk.
And regular monitoring is key too, right? It's not enough to just set up controls. You have to make sure they're working.
Absolutely. Regularly reviewing financial statements, comparing them to previous periods, looking for unusual trends or discrepancies, that's all part of good monitoring. The book suggests reviewing things like budget reports, lists of missing checks, and aging schedules for accounts receivable and payable. Having a CPA review your year-end financial statements is also a good idea.
Finally, the book stresses the importance of ethics and setting the right tone at the top. How does ethical leadership help prevent fraud?
It all starts at the top. If the owners and managers are ethical, if they act with integrity, it sets the tone for the whole organization. Employees are much more likely to behave ethically if they see their leaders doing the same. But if the message from the top is all about profits, no matter what, it can create a culture where people feel like it's okay to cut corners, even if it means crossing ethical lines.
Right, it's about walking the walk, not just talking the talk. Expert speaker.